Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets. The week ended with a big rally, but will that continue? Ross checks out the U.S. and Canadian dollars, crude, natural gas, and gold. Editor of Rick's Picks, Rick Ackerman, is worried the U.S. and China are headed for recession or worse and believes there's no need for further interest rate hikes. He also has a special offer for our listeners. Founder of TheTrendLetter.com, Martin Straith, also has a special listener offer. He comments on how rising interest rates will make it almost impossible for governments to pay off their burgeoning debts. Publisher of WallStreet.com, Wolf Richter, talks about autos, housing, and tech stocks. We'll talk to Ross Clark right after this.
Introducing Ricyclico, making lithium-ion last forever. Ricyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Ricyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt 2AM. For more information, visit Recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at Charts by Ross. Welcome back to the show, Ross.
Always a pleasure, Jim.
Ross, the markets on Friday, everything outlined in green. I haven't seen that in a while.
Yeah, I think I found only one out there. I think Amazon was the red one, but other than that, it was a pretty good day. And you know, Apple got off to a bad start overnight on Thursday after the earnings, but by the time it finished off the day on Friday, it was one of the leaders on the upside. I think it contributed to about 25 points in the S&P itself. So, you know, this is so here we are, the last week, a full week in October, and historically, this is where seasonality kicks in big time. The probability of market pushing well through until May has been pretty good. So we're going to be watching this one pretty closely. You've got numbers. We've had a lot of overdone sentiment numbers on the downside here in the last month and a half. The Ridex bear and bull ratio, which is then the percentage of funds, bear funds that people are holding versus bull, was at an extreme. The put-call ratio topped out at 80, and you only see that probably once in a decade on average. So that's a pretty big extreme. And when you get levels on that ratio up around 80, you can expect an 8 to 12% rally in the S&P. And as a matter of fact, if you take it from the extreme low on that spike that we had just a week ago, we've already done the 12% move. So it'd be interesting to see just how much there is on the upside. Now, I have a bigger model, totally separate from seasonality, that looks at the rounding tops that we've historically had. And this last year, rolling from the November high and then down, has a lot of similarities to other bear market moves. And the rally that we've had here in the last week and a half, this is a double bottom, and we just took out the high between the lows. And the primary target we've been working with for a bounce within the quote bear market was up to the 100-day moving average. That happened on Friday. We look at a commodity channel index, one of the technical indicators. That has gone overbought as of Thursday and Friday. And the sequentials, which we look at look at pattern, they generated an upside level on Thursday that can have a high probability of a reversal. So we will be watching pretty closely here to see what kind of follow-through there is. Historically, once you have a bear market, that can override the seasonality. So we're going to be watching to see if this market's capable of pushing through key resistance levels and treat it accordingly. So, there are some stocks that have excellent track records during this phase. Companies like Apple, the most dominant one out there, and as far as the North American market is concerned, got off to just a great start, sort of brushing off the flat to negative earnings and having just a fabulous close on the week. So we'll see if there's any follow through there.
What's going on with our dollars, the Canadian and U.S.?
The U.S. had a decent pullback here in the last week and a half. Now, back in September, we got some good upside overbought readings on the daily, weekly, and monthly charts. So everything was setting up to go through a corrective process. And so we topped out around 115 back in September. We've been thrashing between 110 and 114 ever since. And what I found is that when we look at the type of overbought reading we've had, usually stays up there for 2 months worth of signals, which we've now had, and then you get a pretty decent correction. So that the index, I wouldn't be at all surprised that you get maybe a small correction into the 109 to 108 range. If it doesn't hold there, the norm would be that we get down to a 20-month moving average, which is going to be quite a bit deeper, maybe around the 102 to 103. And that would be testing the highs that we saw in 2016 through 2021. So it wouldn't be at all surprised to see that there's that decent correction there. Like the Canadian dollar has just been hammered. It got oversold 10 days ago, down at 72. It's had a decent bounce to 74. Might have a little bit more to go on the upside, but I think it's still in trouble. The yen is at a 23-year low right now, and looks like it's just a massive top in here. So for all that it's looking overdone, it's probably not going to do very well going forward.
What's happening with crude and natural gas?
Crude oil into a trading range, and the oil itself has had some good support resistance levels that we've been documenting. This rally has taken us up to 90. So we're putting in lower highs and a higher low if we look at it over the span of maybe the calendar quarter here. So it'll have to get up through, I would say, 91 to show that the upside bias is back in here. Our modeling has some pretty heavy resistance in that area there. Now, nat gas, I chose not to talk about this last week because I didn't think there was much there. Well, that was a surprise. Gas bottomed at just around $5 and managed to get back to $6 during the week here. So pretty good bounce in there. But I look at the seasonality. You would typically have had a decent bounce in October, November, but continue down after that. So I don't see that there's a lot of potential here. Maybe up in the 650 range, and that's about it.
What's happening with gold?
A quiet week. The gold closed a week off at 1647, absolute middle of the trading range. 7 or 8 days ago, we had silver and gold both had sequential 9 buy setups, which typically would give you a rally to the 50-day moving average on gold. That average is just over 1,700, and we only managed to get to 1,775. So it's a little bit weaker than you would anticipate off of a decent oversold level. The miners are not doing that well. The GDX, GDXJ, just sort of biding their time in here, but no upside progress. However, on the silver, there are 4 silvers that we've noted that have had good upside bias, relative strength to the others in the sector and to the bullion has been good. So there's a few silver names that could be worthwhile dipping your toes into.
Ross, thank you so much for the update.
You're more than welcome, Jim.
My guest has been Ross Clark from ChartsandMarkets.com. You can find him on Twitter at ChartsByRoss. Coming up, Rick Ackerman next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, RickAckerman.com. He's speaking to us from South Florida, I believe. Rick, welcome back to This Week in Money.
Indeed, a pleasure, Jim. Always a pleasure. I am actually in North Carolina. I'm enjoying something that we don't get down in Florida, which is autumn and fall colors, and it's beautiful here in Asheville. I can tell you it's a real pleasure being here.
Rick, can you tell us a little bit about Rick's Picks, and do you have a free trial offer for our listeners?
Indeed, I do. It's a 14-day free trial, and if you go to rickackerman.com, up top there's a tab that says free resources. At the bottom, just click on free trial subscription, and you'll be in like Flint. I would also say act soon, because I'm going to be offering a radically revised course on my hidden pivot trading method. There's some amazing tricks, very profitable tricks that we're doing that are really easy to learn. But I am requiring that people who take the course have subscribed with me, subscribed for at least 6 months. So this one is just for the family. So I would say start your subscription now.
And can you tell us a bit about Rick's Picks, how it works?
We have a number of features. There are daily touts. These are for widely traded vehicles, including Apple, E-mini S&Ps, gold, silver, oil, the dollar, bonds, and a couple others. And I provide very detailed technical forecasts every Sunday night, but I update them 24/7 during the week. And I think they've been spot on with respect to trend and price. It seems like the relatively violent markets have produced even greater precision in my predictions. So there's also 2 chat rooms. One is focused on actionable trading advice, and it draws great traders from all over the world. A very helpful bunch, I might add. And we also have the coffee house, where anything goes as far as the discussion, and it's a very fascinating conversation that brings in a lot of expertise. So there's the touts in the chat room. We occasionally have what I call request sessions, where I do technical analysis on demand, and sometimes spontaneous events online. So all those are included in your free trial subscription.
Rick, is the stock market still in a bear market, or could the beginnings of a bull market be underway?
Well, bad news, Jim. I think we're in the beginnings of a bear market. And of course, it began last January, and we've had kind of an orderly move from the January highs down to the recent lows. But I think that the bear market has barely gotten rolling. You know, to think that the excesses that built up over the last 10 or 12 years have been corrected is really, that's delusional. So I think we're waiting for not the other shoe, but the first shoe to drop. So yeah, the bear market has barely gotten rolling.
Mm-hmm. Is it kind of pilots call it a sucker hole, where there's a little patch of blue sky and a stormy forecast, and so you end up flying towards that little blue hole, but by the time you get there, it closes up and you're in the middle of a big storm. Is that what's happened on the stock market this past week? It seemed pretty positive.
Well, the blue hole is entirely the doing of Apple. Apple, as you may know, is the biggest cap stock in the entire world, and a lot of the chimpanzees who manage your hard-earned money have made a good living simply with the genius play of sticking with Apple. They haven't sold any shares since 2009, and it has more than buttered their bread. So you have enormous support globally among portfolio managers for Apple, and they all kind of hang together, and so the stock goes higher, assisted by share buybacks from the company itself. But the sleazeballs who manipulate Apple, the biggest cap stock in the world, and therefore the most visible and important, they've developed a couple of tricks that they use repeatedly, and you'd think if they keep doing the same little game that eventually everybody would catch on, but they never do. And that is essentially to let the stock fall overnight so that sellers are depleted. They're completely exhausted ahead of the opening bell, meaning that there's no resistance to whatever short squeeze gets triggered off on the opening. And it's very effective when the market climate that day is even mildly bullish. So they use this little short squeeze trick, where they do another corresponding trick where in the shallow markets, the illiquid markets that you see Sunday night, they just let a stock drift higher if they see there are no real sell orders on the book. So Apple is a completely manipulated creature, and I have to say there was genius at work yesterday, because when Facebook and Amazon reported earnings and a not very bright outlook for 2023, the stocks got absolutely schmeiced. They were down, I think respectively, like 21 and 25%. And Apple came out with a not quite as bleak outlook, and I'd say even a mildly upbeat announcement. But and they initially hit Apple like for 20 points. It went all the way from 156, I think, to 136, and it was overnight. They short squeezed the stock overnight, so that it's now trading at its highest point over the last 3 weeks. So this is going to carry into next week, and when you have a big important stock like Apple in this completely manufactured short squeeze rally, it's going to affect other stocks. So even though I view myself as probably the most bearish bear out there, it doesn't stop me from seeing higher stock prices, which is what I think we'll have into next week.
What are your short-term and long-term outlooks for the stock markets?
I think that the bear market will bottom at a level I'm not even gonna mention a number, because people are gonna think, what a lunatic. But just suffice it to say that the market will become as oversold, ridiculously oversold, as it has become ridiculously overbought over the last since the bull market began in 2009. So I think things are looking pretty bleak.
The Bank of Canada increased the bank rate by 0.5 point earlier this week. Now it's the Fed's turn in the U.S. in the coming week. What do you think the Fed's going to do?
Well, I'm hearing an additional 75 basis points, but the last few times we've talked, going back maybe 150 basis points lower, I said that I thought rates were already high enough to put the whole world into a depression, and I still think that. So let's say there's a little bit of overkill. There are interesting theories out there, one from Tom Longo, that sees the Fed as not being so stupid or villainous, but that, in staying the course, the Fed in maintaining this tightening course will come out of whatever we're about to enter looking better than all the other central banks. But I think the error in that logic is that what we're going to come out of is something we're not going to come out of. We're going into something much deeper than a recession, and the Fed, in gambling that the the central bank would look pretty good when the world emerged from recession. I think that they miscalculated, and that what they're putting us into is much deeper than recession.
Do you see higher interest rates ahead to reel in inflation?
We don't need them, and they're high enough. Interest rates could come down to 2%, but they would still be rising relative to falling collateral values, and when I talk about deflation, and I can see a lot of gurus are now, and pundits are sort of coming on board with the fact that this inflation cannot possibly end in an inflationary way. The bust has to give us deflation. And, so I think a lot of them are starting to see the logic. But as we experienced in the 2007-8 real estate collapse, the deflation need only take into account the real burden of interest, the real burden of debt. And of course, if interest rates stay steady at 2%, but home values are falling at more than 10% a year as they did back then that 2% mortgage or 3% mortgage can become a crushing burden. So it's only the real burden of debt that matters, and for that reason, interest rates don't have to go any higher to become asphyxiating.
Do you look at this inflation we're experiencing more of a supply chain problem than that of a financial crisis or monetary problem?
Well, I mean, it's a crisis. You can see that it can't go on forever. I mean, wages haven't even remotely kept pace with inflation. So as people cut back on essentials, prices can only go but so much higher. We do have some inflation still in the pipeline from food that will have been grown with a very, very pricey fertilizer, for one. So there's still some inflationary things left to play out. But on the affordability side of it, you can only have so much inflation when people are at the point, it costs $5,000-$6,000 to fill up on diesel heating fuel for the winter, and there's a lot of the middle class is really pretty well sandwiched right now. So again, how much inflation can you have if people are stretched to the limit and sort of cutting back on protein, eating spaghetti, so to speak, just so they can heat their homes? So inflation does not have too much further to go, but the bad news is the alternative, deflation, is going to be much, much worse.
Does the U.S. dollar look like it might have topped?
Not at all. I think it's going much higher, and that's the crux of deflation, that everybody who borrowed dollars will be challenged to pay them back the higher the dollar goes relative to other currencies. And of course, part of that, the dollar's quote-unquote strength, has to do with the competition. All the other currencies are getting trashed by their sovereign creators, and I guess that makes the dollar look good. But part of the dollar's strength will come out of purely deflationary forces, meaning that in order to roll over debt, you'll need to keep coming up with dollars that are getting scarcer and scarcer, and that's partly what's driving the dollar, is that debtors are under pressure now to just service their loans.
Your thoughts on crude?
Crude sometimes amazes me. It's hard to see why it's going higher at all. We've got some great people in our chat room, real energy experts, and they have some interesting explanations that have to do with more or less organic forces of supply and demand. But looking at a bigger picture, with the world sliding into depression, and that includes China, which at the margin it prices oil. It's your biggest energy user at the margin. It's hard to see crude just keep going up and up and up. But that said, there's always going to be the exogenous geopolitical possibility, like things happen in terms of disrupting global supply and demand. So oil is always a dangerous short. But I think based on fundamentals and the fact that so much debt is pledged against energy assets, I see oil eventually going below $50 a barrel, way below.
Your thoughts on natural gas?
It's just kind of crazy, you know. We're exporting natural gas to Europe, and it has the effect of pushing up prices here. Not a very popular political solution, but I guess the U.S. can sort of come off as Europe's white knight. But just the same, the prices are amazing, and of course, people who live in very cold places are not going to be that much better off for the U.S. natural gas that's being exported. So, you know, over time, certainly over this winter, you're going to have remarkable upward pressure on natural gas prices. But I think, and they'll probably be more stubborn coming down than pump prices for fueling cars.
Could gold be getting ready for a move?
Well, it's been moving pretty nicely. It depends which currency you measure it against, but I would say that the gold has been in a massive correction of since 2011, really. But within that correction, we've had more recent years a pretty good rally against which we're correcting now. So gold, weakness persists for long times, but you have to keep in mind that the weakness is against larger rallies that are bullish. But I've never been a gold $5,000 an ounce kind of guy, much less 50,000. But it's always seemed obvious that gold, as an investable asset, will retain its purchasing power really well relative to any other class of investables that you can think of.
Are the stock markets a place where people can get rich?
No, I don't. We're entering a deleveraging period, and if you look at the great fortunes and the billionaires, all of them made their money in leveraging situations in environments where the price of everything went up and you could borrow against those rising prices to buy even more. So it was kind of a perpetual motion machine. But we're going to have that in reverse. You know, deflation is fundamentally a deleveraging event. And as such, I think even the geniuses will be challenged to hold on to 10 to 20% of their current net worth. So no, I don't buy into these ideas that, you know, it's one thing to protect your nest egg in what is coming, but I don't buy claims that, you know, here's a way to make out like a bandit when the global financial edifice is shrinking by perhaps 70 or 80%.
What are the best trades you've ever made?
Probably when I was an options market maker, one of my buddies was a guy who was clerking on the floor, but he was also driving a cab and making a few bucks on the side selling cigar box labels. Well, he looked hungry to me, and I started him out with just $15,000, and it returned an enormity. He just did well. That was probably my best home run. At another point in my life, there was Lowe's Corp, which was run by two of our neighbors, Larry and Bob Tish, and everybody in Margate had a piece of Lowe's, and if you had just $1,000 worth of Lowe's, over time it became worth $1 million. So Lowe's was a great winner too.
Rick, in this kind of an economic environment, is there such a thing as a safe haven or a safe play?
No, there's only just protecting your assets, and part of that should literally be in cash. I've talked in the past about keeping a shoebox full of 5s, 10s, 20s, 50s, and 100s, because when we have that day when the stuff hits the fan, and we get shifted into a barter economy, those paper currency bills are actually going to buy things because the clerks on the other side of the counter will be familiar with them. It's going to take a little while for your pre-1964 silver, your junk coins, to appreciate commensurately with their value, because initially they're going to transact just as nickels or as dimes, quarters, halves, and dollars. But it's somewhat ironic that the shoebox full of paper bills should be worth anything, because fundamentally they are not. You know, the dollar bottom line is a form of debt. Each dollar is not backed by anything really other than the indebtedness of the U.S. government. So it's not exactly perfect money, but I think in a barter situation it'll do in a pinch.
Rick, how can people sign up for your free trial offer and subscribe to your products?
Oh, it's so easy, Jim. I'm glad you asked. Just go to Richtackerman.com there on the home page, and up top there are a few tabs, and where it says free resources, just click on that, and at the bottom, free trial subscription, and you'll be signed up for 14 days. Be sure to say hello when you get in the chat room. I did mention earlier, it's one of the world's great chat rooms, in part because it's not the usual Tower of Babel where everybody speaks a different language. In this room, there are many, many traders who are more than proficient with my own hidden pivot method, and so a lot of them speak the same language technically, but they have their own expertise and technical things to contribute. So it's, I think, the best chat room in the trading world, and you'll be real pleased when you see what goes on there. And of course, if you want a break from the usual discussion that you hear online and in the blogosphere, just come into our coffee house and sample some of the amazing conversation there. So again, Richtackerman.com, just click on free trial up top.
Rick, thank you so much for being on This Week in Money.
Well, I surely appreciate the opportunity, Jim, and thank you very much.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, Richtackerman.com. Coming up, Martin Straith, next on This Week in Money.
Introducing Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt 2AM. For more information, visit Recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, British Columbia. That's just down the road from Vancouver. Welcome back to This Week in Money.
Thanks, Jim. Great to be here.
Martin, can you tell us a little bit about thetrendletter.com and how people can subscribe to it?
Sure. Well, we publish 3 services, investment services. We've got the Trend Letter, which was the original one back in 2002. So that's been going for over 20 years now. So that publishes every Sunday, covers equities, currencies, precious metals, commodities, bonds. Each weekly issue is about 50 pages, mostly charts. So we're very visual, and each chart has some key bullet points to make it really easy to understand. The focus here for long-term investors, people who want to get a better understanding of what drives these markets. The second service is Trend Technical Trader. Now, that's an online service that started out as a hedging service, which has been excellent in this last year with this terrible bear market that we've been in. It also covers many other sectors, including commodities, equities, and precious metals. Focus there would be for more active investors, but long-term investors have also done very well, especially with those hedging strategies. And our third service is the Trend Disruptors. That's a monthly publication with new disruptive ideas in the artificial intelligence, virtual reality, augmented reality, 5G, cloud, Internet of Things. Very speculative sector, obviously, and in fact, we have not even recommended anything in the last almost year in this bear market. But we do have a great list built up. We have about 30 companies in that. So we'll be, when we see the bottom in the market, we'll be issuing out buy alerts to subscribers. Focus here would be people wishing to speculate with risk capital that they can afford. So those are our 3 services that we offer to help subscribers get more successful. To subscribe, just go to the Trend Letter, so all one word, thetrendletter.com. They can, if they got any questions, just email us at info@thetrendletter.com.
Is the stock market still in a bear market, or could we be seeing the beginnings of a bull market with the whole stock market board outlined in green on Friday?
Well, yeah, Friday was a great day, but to us, we're still in a bear market, although we are in the strongest seasonal period, which runs from October to May. But what I think investors need to understand that bear markets have 4 stages or phases. You know, the initial one is the stealth phase, and that's where the smart money gets in early. The second one is the awareness phase, and that's where your large speculators come in. And then you get the mania phase, and that's where the retail and general public come in. And then you finally get what's called the blow-off stage. So at the top of the mania phase, everybody wants in, even those people who don't even cover the stock market. You know, we call it, the fear of missing out. And if you think back to 2021 when we had the Reddit crowd pushing up those meme stocks like GameStop and AMC, that was a perfect example of a mania phase top. But after the mania phase, you get into the blow-off phase, and that's where the stocks market starts to decline. This is where, you get investors fall into denial. They're hoping the markets will rally back to those highs, but it just keeps getting lower. And then eventually we get into the capitulation kicks in, and ultimately we get into the despair at the bottom. So, Jim, if we looked at those phases and overlaid the current S&P 500 chart, it tells us that we are in the blow-off stage right now. And this would tell us that any rally, like what we're seeing right now, will be another short-term relief rally. Maybe it lasts a few weeks. We've got the U.S. election coming on November 8th, so that might be interesting. But we still need to see that capitulation and ultimately despair kick in before we finally see the bottom. So, based on all that, I say we're still in the bear market.
What are your short-term and long-term outlooks for the stock markets?
Well, as I said, October to May is typically the strongest period, so that's bullish. And again, as I said, we're currently in a short-term relief rally. And again, that midterm U.S. election, I think the results of that could impact the market, certainly if the Republicans gain control. Our initial target for this current rally was the 100-day moving average, which was 39.10. Now, last I looked at the market, it was 38.98. So it's very close to that target. A close below 3,800 suggests that we're likely heading lower. So we really want to see what happens in that U.S. election. Obviously, other key factors are the central banks. The Bank of Canada just raised their rate less than expected, so 50 basis points instead of the 75. If the U.S. Fed does the same thing next week, the markets will get a nice boost. Now, longer term, we see May as a very key timeline. And if we rally to a high in May, I think we're going to see a significant reversal and decline at that point. So that could be our capitulation stage. So what could cause such a move? Perhaps, unfortunately, the escalating geopolitical problems, whether it's, the Ukraine or China and Taiwan. Any of that could certainly cause grief for the markets. Ultimately, though, we need to see that capitulation and despair where people just don't even want to talk about stocks anymore. That's when we'll be sending out buy alerts to our subscribers. So eventually we're going to see much higher equity prices, but we need to get through May and see where we are at that point.
What is the sovereign debt crisis, and should we be concerned?
Well, the reason to be concerned is that every country has borrowed much more than they could ever pay back. Most investors don't realize this, but the global bond market is huge. It's $127 trillion. Now, a sovereign debt crisis happens when investors lose confidence in the government and they no longer want to buy government bonds. There's a big difference between public debt, so that's government bonds, and private debt, which is corporate bonds. When a company defaults, their assets get sold off, and then the bond holders get some portion of their investment back based on the value of those assets. When a government defaults, there are no assets to sell off. So bondholders of government bonds could get nothing back. the real risk here is that once one country defaults, panic spreads. And the panic would spread quickly, and then investors in these other countries start to look around and they start to wonder, well, who's next? Then those investors, they start selling off their government bonds. It's really like a run on the bank. It spreads. Its contagion kicks in on that. Governments everywhere need to issue bonds because they got to pay off these massive debts. When there are no more buyers for the bonds, then the governments obviously can't pay off their debt. So the other thing that we need to really watch here is a real possibility of a world war. As investors, we need to understand that historically, a world war gives the government the excuse to default on their debt. And the way these so-called world leaders are talking, a world war seems more likely all the time. So for the last year, we've been now warning our subscribers to get out of long-term government bonds. Short-term bonds are fine. 3 months to 2 years, great. You actually get a better return than on the long bond anyways.
What are the chances of a global recession?
Oh, I think they're high. The standard definition of recession is 2 consecutive quarters of decline in GDP. Well, given that definition and that the U.S. has already been in the 2 quarters of negative GDP, that suggests they've already been in a recession. And there's a lot of other countries and major economies in the same boat. The UK, Germany come to mind. Central banks keep raising rates, and that's going to hit their economy. Now, there's a lot of other indicators that strongly are suggesting a recession's coming. In the U.S., they have the Conference Board, and it has its leading economic index, and it's been a great predictor of recessions. So, just in their recent October report, their line was, a recession is increasingly likely before year end. Now, another great accurate forecaster of recessions is the yield curve. Now, in a very rare situation where a long-term bond, say the 10-year bond, earns less than the shorter-term bond, say the 1-year bond, the yield curve is inverted. Now, normally you'd go, well, if I'm lending the government money for 10 years, I would certainly expect to get a higher return than for just 1 year. But that's not the case today. When the curve inverts, it's telling us that investors want to lock in long-term rates because they expect the economy to decline. So here we are today. The yield curve is inverted. Jim, since 1955, there's only been one time where the yield curve inverted without there being a recession. So I think the chances of a global recession are pretty high.
What is the real central bank rate for the Fed and the Bank of Canada?
Well, this is important because there's a lot of chatter out there right now that the Fed's going to soon pause or pivot off rate increases. But we have to remember that the Fed Chair Powell has stated clearly that the benchmark lending rate must be higher than the inflation rate. What he means by that is the real rate, what you're saying is what's the real rate? It must be positive, meaning the Fed rate minus inflation should be a positive number. Well, today, the Fed rate is 3.25%. Now, they have a meeting next week, so they're probably going to raise it, 50 to 75 points. But their inflation rate is 8.2%. So 3.25 minus, 8.2, they have a negative real rate of 4.95%. In Canada, the Bank of Canada just raised rates 50 basis points to 3.75. Inflation here is 6.9. So Canada's real rate is a negative 3.15. So both Canada and the Fed have been clear that they want inflation lower. So if these guys stick to their goal of real positive rates, we need to see a combination of lower inflation and higher rates. And it's not just Canada and the U.S. Pretty much every central bank's in the same boat.
When will the Fed pause? Is that the answer?
Well, I think I mentioned last time I was on here that predicting what the central bank's going to do is a real challenge because they almost always are wrong in their forecast. But as I just mentioned, the Fed has stated they want to get inflation under control. Powell says he wants real rates to be positive. So now there's an election in a little over a week in the U.S. The Fed meets next week to announce their next action. Now, the market's priced in a 75-point hike Now, they could follow the Bank of Canada and only raise by 50 points. So I do believe that they could certainly slow the pace of these increases, Jim, but I don't see them stopping until they get to that 4.5%, maybe 5% rate. They want to get close to that positive real rate. So until they get there, I don't see them actually stopping.
What do rising interest rates mean to governments that have racked up massive debts?
Well, just like all of us, governments need to pay their bills. So governments all over the world have, they've racked up massive bills due to their huge debts. So rising interest rates means that the cost of servicing those debts rises. Like if we look at the U.S., for example, now the official U.S. federal debt is now over $31 trillion. I mean, to put that into context, that equates to over $93,000 per citizen, or more importantly, $248,000 per taxpayer. Now, back in May, prior to the Fed raising interest rates, the Congressional Budget Office, they projected that the annual net interest cost for the U.S. government for 2022 would be about $442 billion. Now, they projected this cost to almost triple over the next 10 years, soaring from $442 billion to $1.3 trillion and to sum of $8.1 trillion over that period. Now, given that inflation has risen much higher than the CBO's projection and that the Fed is raising rates much higher than the agency projected, I mean, these interest costs to service that debt is going to be much higher than they projected. I mean, you think about this, Jim. The U.S. government will spend probably close to $9 trillion over the next 10 years to simply pay interest on their debt. That's $9 trillion that is not available to social programs, education, or whatever. And in Canada, it's the same scenario. I mean, our numbers are smaller, but the impact's the same. So rising interest rates means even higher debt servicing costs for these governments.
Martin, does the U.S. dollar look like it might have topped?
Well, certainly in the short term, it's looking pretty toppy. I mean, at the end of September, the U.S. dollar was very overbought, and we warned subscribers then that watch for a pullback down to the 110, 108 level. Now, right now today, it's sitting just above 110 right now. So what we're seeing is that other central banks, like the Bank of Japan and the ECB, they've been looking to boost their currencies and slow the rise of the U.S. dollar. So what they're doing is they're selling off U.S. debt, meaning U.S. bonds, and they're selling off the U.S. dollar. So we expect to see this pullback in the dollar, last maybe a couple more weeks. The high has been in 114, so that remains the near-term resistance. Longer term, we see the U.S. dollar trading up to the 120 level. Do note, though, that currency moves have a tendency to run longer than seems logical at times.
Is the Bank of Canada going to need to be aggressive with interest rate raises to support the Canadian dollar? Well,
you know what's interesting about the Canadian dollar is that it has a really strong correlation to the S&P 500. Over the last couple of months, we have moved in. They have both moved in lockstep with each other. Now, the Bank of Canada just raised rates 50 basis points this week. The Fed's likely to do the same, or even go 75 points. But given that both central banks are keeping their rates basically the same, it really kind of gets back to how strong the U.S. dollar is. As I mentioned before, at the end of September, the U.S. dollar was extremely overbought and it's been pulling back. Now, the Canadian dollar was oversold and it's been rallying this last week. But moving forward again, to me, it's all about the U.S. dollar will dictate what the Canadian dollar does. For the Canadian dollar, we have 72 cents as the near-term support, and that held last week. If it fails, our next target would be 68 cents.
How are other currencies performing?
Well, same story. It's really about the U.S. dollar. When the U.S. dollar is strong, most other currencies are weak. U.S. dollar is weak, the other currencies get a boost. Recently the U.S. dollar had a bit of weakness, and you see most currencies have had a nice little rally lately. Now, prior to this week, we saw some historic lows in many currencies. The Japanese yen had fallen 33% from last year's high to last week's close. I mean, that's a 32-year low. The Japanese central bank, as I mentioned earlier, has started to intervene, as has China, I think, And we suspect that the ECB has also done that to try and boost their local currencies. Now, in the euro, it's been in a 2-year decline, and it actually fell below par to the U.S. dollar. Now, this week it's been rallying, and it managed to kind of get above par there briefly. But here today I just looked, and it's dropped back below par. With the UK, the pound's been bouncing around a lot with all the political things going on over there. And it fell to a 37-year low in September, but now it had a nice little bounce last week. It was up almost 10% from that low. So again, Jim, it's really all about the U.S. dollar for currencies.
Yeah, Britain's game of Prime Minister of the Week. Your thoughts on gold?
Well, precious metals, they've been frustrating since March. I mean, from the March high, certainly hasn't been a hedge for inflation. Again, the U.S. dollar comes into this. That strength in the U.S. dollar has been a real headwind for gold. But what we like recently is that gold has been forming a basing pattern. It was down, I think, $20 today, but what we're really looking for here is the 1630 level. That's been acting as key support. It's been held twice there now, which is positive. So again, if that level can hold, we're looking at a rally should happen here. Needs to break above 1700, then 1740, 1815 would be the next one. Longer term, we see a real strong rally for gold and silver. As long as that 1630 support level holds, I like gold and silver here, and we have been accumulating here.
Anything else you think we should be keeping a close eye on, like crude and gasoline? Yeah,
well, I mean, looking at crude, short term, oil has been rising, partially due to the pullback in that U.S. dollar. It's, today on Friday, it's struggling again. The U.S. dollar has been higher. Oil is technically overbought, though, in the short term, so we're looking for a pullback. Near-term supports is around the $82 level. And again, the other thing that we see is the recessionary pressure, and we kind of, are forecasting that oil will drop below $70 before we see a big run. But longer term, we see much higher oil prices in 2023. On the supply side, the U.S. has been draining their strategic reserves, releasing 180 million barrels of oil. But that's now ended. And now they've committed that they're going to buy back and replenish the reserve, meaning that they will be adding to the demand. I mean, this has been a big election ploy here. They flood the market with oil right before the election, keep those gas prices down, and then they have to buy it all back, and that's going to drive prices higher. They also have the governments with their windfall taxes, severe regulations. These are major disincentives for producers to invest in exploration, and looking for new sources. So long term, we actually see oil up in the $150, even $200 level in the next 12 to 18 months. Another thing, Jim, energy stocks have done well. And so what we're expecting to see a sell-off in those energy stocks coming in tax loss season, because a lot of investors have some big losses in those other sectors like the tech sector, and they're going to want to offset those with some gains from the energy sector. So we expect that we're going to be sending out buy alerts to our subscribers during that tax loss season, somewhere around late November, early December.
Martin, how can people follow you and find out more about the Trend Letter?
Well, they can just simply go to our website, thetrendletter.com. So that's all one word, thetrendletter.com. Also, Jim, I post market notes on the site, and for today's notes, what I'll do is I'm going to post links to offering your listeners some special offers to each of our services with some great savings. And also, your listeners can sign up for our free daily headline service. And what we do there is every day we review what's happening in the markets every morning, and then we send out the headlines that we feel all investors need to be aware of. And a real key point here, Jim, if people sign up for that free service, they will not constantly be spammed like so many services do. I hate spam. I don't do it. We don't do it. If your listeners have any questions about any of our services or any questions at all, they can just email us at info@thetrendletter.com.
Martin, thank you so much for being on This Week in Money.
My pleasure, Jim. Take care.
We've been speaking with Martin Straith, founder of Trend News, online at thetrendletter.com. He was speaking to us from Coquitlam, just down the road from Vancouver. Coming up, Wolf Richter, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Wolf Richter, publisher of WolfStreet.com. He's speaking to us from San Francisco. Wolf, welcome back to This Week in Money.
Thanks for having me back, Jim.
Wolf, how are things at WolfStreet.com, and how can people sign up for it?
Well, we're rocking and rolling here. We've got a record year. WolfStreet.com is free. There's no paywall. You don't need to sign up for anything. You can just come and look at it. All about business, finance, and money. No politics. And we have an email service where you can sign up for. It's also free. And there's a link at the bottom of each article.
Twitter is no longer public. It's just gone private with Elon Musk. It's open for free speech. What's causing the bloodbath in social media stocks?
The advertising malaise, online advertising, is starting to be impacted by the macroeconomic issues, and social media stocks make all or nearly all of the money off of advertising. And I see that too. You know, my side runs ads, and so I can see what's happening in the advertising market. And like Facebook, they place 17% more ads, but their revenue per ad went down by 18%. So they're still able to place more ads, and maybe they're being too aggressive with them, but they're getting paid less per ad. And I see that, and everybody sees that. And so all of the social media stocks have gotten hit by that. The Snap, Twitter obviously not, because it's really not a public company anymore, but Facebook and all the others that are advertising supported. It's a very tough situation for them right now, in a sense, because they're priced, the stocks are priced for high growth, and when advertising fizzles, then the growth goes out the window. And then in addition, Facebook has some huge other problems that have nothing to do with advertising, and it has competition from TikTok and some other entities, and it made some huge missteps, and there's a whole other there's other issues that it has. The same thing with Snap, and so there's more involved than that, but their revenues are based on ads, and online ads are just right now not doing very well.
Could Meta Facebook be the next buyout candidate?
Yeah, no, I don't think so. I'm not right now. I'm not at the price. The shares have plunged over 70% from the high, but the company is still valued at this price at about $270 billion. And that's a lot of money. A buyer would have to offer a premium over that. So it would be over $300 billion. That is a huge buyout. In addition, Zuckerberg owns the voting majority, so the shares that he has, he can control over half to the company, and so he has to agree to the buyout. And I just don't think that at this price that it is just financially even possible to do this. Twitter, that buyout barely went through, and Musk is trying to walk it back, and he's the richest man in the world. He's putting his own billions at work here. But that's not going to happen with Facebook. It's just too big. And, so I don't think the stock drops, 95% from the high, and that's possible. Then the company would be valued in the range. So it's already dropped 70-some%. So if it drops 95%, the company stock might be valued in the range or it would be a buyout candidate. if somebody wanted to own it.
What's happening with the dump in tech stocks, and are some sectors within tech getting hit harder than others?
Well, the chip makers, the makers of high-end processors and memory chips, they've gotten really hit hard. And that has to do with, there's three things that came together. Everybody bought PCs, laptops during the pandemic. They all have them there. They're not, so sales have plunged in these. Then we have the crypto mining market that kind of imploded. So crypto mining rigs, which require a lot of high-end expensive chips, that sort of went away, and that's NVIDIA's business. And then now we hear from Intel there's weaknesses in the data center business. So we have these three legs that the chip industry stood on. They're all wobbling now, coming down pretty hard. The Windows sales for Microsoft dropped 15% because of the chip decline, because of the PC decline. So this is rippling through the high-end chip makers. Now, automakers, they're still short on semiconductors, but they use low-end microcontrollers that run the stuff that, your mirrors and your door locks and the sensors in the engine and all this stuff. And these are not big processors and memory chips. Now, these are very small, old, trailing edge chips. Many of them very specialized for automakers that have to deal with the heat and the vibrations and all the stuff that's going on under the hood. And they're still in short supply. So on that end of the market, there's still a problem in supply. But on the high end, on the leading edge stuff, the memory chips and the processors, the graphic processors, those kind of semiconductors, we now have a severe plunge in demand, and Intel stock's down 60%, NVIDIA is down a bunch, and they're all down a whole bunch. And so that end of the tech industry, and the software providers too, so there's a lot of software companies, including Microsoft, that feed into that, and they've all gotten hit pretty hard.
Bubbly housing markets in Canada and the U.S. are getting hit by higher interest rates. In the broader sense, is this something we should worry about?
Yeah, it's interesting. We have this blow-off top in the housing market, and in lots of places, home prices went up by 50% in a 2-year time span. And so your $1 million home, within 2 years, suddenly has a value of $1.5 million, and then prices decline, and so if they drop 33%, you're back to $1 million. So now you're back where you started out, and nothing really happened. So if you didn't do anything, if you don't look at Zillow, nothing's changing, this impacts only people that bought homes last year, and or maybe last year and a half. That's a serious issue for them. But it's not a large number of people. Already volume was lower back then, and so it doesn't impact a lot of buyers. In addition, 33% decline from peak is pretty hard, but even if prices go down 50% from the peak, like they did during the housing bust in the United States, the prices are still relatively high. It would only take them back to like 2019. And, that's still not a big issue. So, because we have this huge spike, you gotta remember, this is a gigantic spike. If that gets unwound, it's really not the big of an issue. In addition, unlike during the financial crisis, now mortgages are rolled into mortgage-backed securities. They're sold, to investors, so to bond funds, insurance companies, pension funds. Central banks have bought them. Governments have guaranteed the underlying mortgages. So the risks are spread far beyond the banks, and the banks really shuffle off that risk and are no longer on the hook for the big parts of that risk. So I don't foresee, even if there is a mortgage meltdown, it's not going to cause a financial crisis like we had. It's going to cause a lot of moaning and groaning among investors because they're losing money. But it's not going to take down the banking system. And so overall, I don't think this is a big issue like it was, during the mortgage crisis in the United States.
How long does it take for rising interest rates to exert downward pressure on home prices?
Well, we're already seeing it. We're seeing it a lot. It started maybe earlier in Canada than in the United States, but home prices have come down a bunch, and now in some cities that both in Canada and the United States have come down by record amounts, like in Seattle, in Vancouver too, in San Francisco, they're down 4.8% in 1 month, and borrow 10% from the peak, or about 10% from the peak, and this went very fast. So now we've got 7% mortgage rates, and here in the United States, and the housing market is frozen up. There's hardly any transactions. Mortgage applications plunged. Buyers are not interested. Sellers aren't cutting their prices. So we've got that kind of situation going on. But the homes that do sell at a far lower price.
In the early 80s, interest rates from around 10% to 20% doubling. Now with debt bubbles and fast rising interest rates, could home prices in the economy end up being worse than what we saw in the early 80s?
Well, in the early 80s, we had the double-dip recession, and that was the result of monetary tightening that finally knocked down inflation after a decade of inflation getting worse and worse and worse. And that's the price the economy paid to get 40 years of essentially declining inflation and declining interest rates. And so even back then when they brought down inflation, inflation didn't immediately just collapse. It went down and it went up, went down, went up, went down, and it stayed relatively high by today's standards, and interest rates stayed relatively high. And so if you bought a home in the late 1980s in the United States, your 8% mortgage, 9% mortgage was standard back then, and in terms of, home prices have risen tremendously during the past 10 years of ultra low mortgage rates, and some of that is going to get unwound. That there's no doubt in my mind that these higher mortgage rates and these high home prices can't coexist. So something has to give, and given the amount of inflation that we have, it's going to be home prices have to come down, and meaning if a seller wants to sell a home, they have to go down to where the buyers are, where the buyers can afford it, and so that's where the market will be. In terms of the economy, I kind of right now we got third quarter GDP is strong, and in the United States, and first 2 quarters were weak, and fourth quarter is probably going to be a little weaker than third quarter. Next year maybe we'll get the recession that everybody's talking about. If it's just a mild recession, maybe it's enough, maybe it's not enough to knock down inflation. That's the problem. If you get a recession and it's not strong enough to knock down inflation, and then you got both. You got a recession and you got inflation, and you'll eventually come out of the recession, but you still have inflation, and you still have to deal with higher interest rates and lower asset prices. That's what higher interest rates mean, is lower asset prices, and by definition, essentially, and same with homes. So, as long as inflation stays high, I think there will be pressure on the economy and on asset prices.
The Bank of Canada just raised its central rate by another 0.5 point in the past week. Now it's the Fed's turn. What do you think it's going to do?
75 basis points next week. We just got our inflation measure that the Fed uses as its yardstick for its 2% inflation target. So that's core PCE. And that came in at 5.1%. It has gotten worse, not better, for the past 2 months. So there's no sign that inflation is slowing down in the United States. It's outside of gasoline costs and some commodities, so the underlying inflation, especially in services, has been rising, and there are no signs of backing off, and the Fed sees that too, and they've commented on it many times, and they'll raise 75 basis points next week. They'll probably raise in December again, and then early next year. At some point, they're going to stop, and they're going to hold the rate flat, and they're going to watch and see what happens to inflation. Starting a year ago, I thought they would raise to 4%. By the end of the next week, we'll probably be there. I think they're going to raise more now. They're going to go above 4%. Some economists said they'll go to 5%. There's just no progress on inflation. That's going to have to deal with that. And the way to do that is to raise short-term interest rates and to do quantitative tightening with the balance sheet. And I think eventually they'll get this under control, but not by backing off now. And they know that. I mean, they've watched the 1970s, 1980s fiasco where central banks backed off and then inflation has surged, and they're mentioning it, and they know we're not going to prematurely back off. That's going to be the wrong thing to do. And we're not at the end of the rate hike cycle.
For automakers, are electric vehicles cheaper to produce than internal combustion engine vehicles?
Well, they're a lot simpler to produce, that's for sure. The batteries are expensive, but the rest of the vehicle is a lot simpler to produce. If you open the hood of your EV, you'll have a luggage compartment in there instead of an engine. ICE vehicles are incredibly complex. The powertrain, the transmission, the cooling systems, the lubrication system, everything is incredibly complex, and it's controlled with computers, and it is expensive to produce powertrain. U.S. automakers have gotten out of the business of making ICE cars because they can't make any money with them. They're too expensive to produce. And so now that you buy a sedan in the United States, it's going to be made by a foreign automaker. EVs, in theory, will be cheaper to produce. Tesla has the biggest profit margins in the industry because its cars are relatively expensive, near luxury, and because they're relatively cheap to produce. So it has gigantic profit margins, and they're the envy of the entire industry. And so Tesla can afford to cut prices, and it is now doing so in China. It's just announced a price cut there to fight off competition, and it can do so in other countries if other automakers encroach on its territory. What the problem we have today is that automakers are still just getting started. They have models out, but they're relatively low volume models, and GM still hasn't hardly anything. They have the Bolt, the older Bolt, that was 2 years ago. They have that, and they cut prices on it. But in terms of the new generation, there's really hardly anything coming out that's mass production. Ford has started, but the numbers are still small. Hyundai, Kia, they've got good models on the market now that are getting market share and that are priced relatively lower than like Tesla. So we will see price competition move into this market once we have more competition, and then we'll see what the profit margins are, how low they can go. But from what we see from Tesla, the Tesla is having a field day right now, charging a large amount of money it gets for its cars, and with the relatively low production cost it has.
What's the latest on the new car and truck markets?
Inventory shortages for vehicles that have a high fuel economy, and that includes, of course, EVs and hybrids, but also small cars, compact cars, and we're starting to have a buildup of inventory of trucks, and especially some brands like Ram, and the less fuel efficient vehicles have sort of fallen out of favor a little bit. So the situation reversed. A year ago, you couldn't get a truck. Now you can get them anywhere, and they're cutting prices on them. There's discounts. Ram has big discounts on their trucks in the United States. Ford has now 2.9% financing on trucks, so they're buying down the financing rate. they're incentivizing sales. You know, that's what automakers know how to do. If sales slow down, if inventory slow up, you cut prices, you put incentives on the vehicles, you buy down the interest rate, you do those kinds of things, and that's what's happening with trucks right now. So this is a very important turn of events. You know, what you couldn't get last year, there's plenty off now, and what there was plenty off last year, you can't get. So there's huge waiting list for vehicles with a high fuel economy, and you know, and so buyers are going to be frustrated. Now the gas prices are high, they're looking for vehicles with high fuel economy, and they end up having to order them and get on the waiting list and wait.
What's the latest on the used vehicle market?
Well, I've been screaming about that for over a year, and I've been exhorting people to not buy at these crazy used vehicle prices that we've had. I mean, that jumped 40%, something like that in a year. And that's completely nuts. And when you buy a used vehicle and you pay 40% more than somebody did a year ago, when you pay more for a used vehicle than, somebody will pay for a new vehicle. Yeah, this is a completely crazy situation, and I tell people not to buy used vehicles under these conditions. Just drive what you have and until it settles down. And so now when the process of settling down, the wholesale prices have come down quite a bit. Retail prices have proven to be a little stickier, but they are starting to trend lower. The asking prices have come down a little bit. Dealers are very reluctant to cut their prices because they've got certain amounts in their vehicles and they don't want to lose money, and there's not a huge amount of supply coming in from the rental cars. So they're still, the rental car companies are still having trouble obtaining new vehicles. So the outflow, the out-of-service vehicles that normally amount to 2 to 3 million vehicles per year in the United States, that has slowed down a lot. So that supplies the used vehicle market, and that supply is still not very high. And dealers are, at this point, under not a lot of pressure to cut their prices. But there are some, so you're starting to see a little bit that, and big dealers have started to warn about it. But I think it has just started. There should be much higher, much bigger price declines coming. And I think people should refuse to buy at those prices. These prices are crazy. The only way you get this kind of inflation down is by not buying, and a vehicle is the ultimate discretionary purchase. Unless you wreck it and total it, you can just drive what you have for another year and see what happens. And I think people should do that until the prices come down enough.
Would you consider buying an electric vehicle?
Sure. I mean, for us, it would be ideal. We just bought a hybrid before the pandemic, so which is great, and thank God we have it now. The gas prices are so high because you cut our fuel consumption in half. So that was a godsend. My wife uses it to drive to work, so we live in San Francisco. I'm on foot. I don't go. I work at home, so I don't really need a vehicle, but she drives it to work. She drives down into Silicon Valley, and every day, and she would love to have an EV that she can just plug in overnight and doesn't have to go to the gas station, doesn't have to mess with all this stuff. And so it's going to be at the top of our list when we start looking again, which we won't for a while, but when we're ready to look for another vehicle, we're going to be looking at them.
Wolf, where can people subscribe to wolfstreet.com?
Go to wolfstreet.com. It's free. There's no paywall. There's no need to subscribe. You can just go there. Business, finance, and money. I have an email service. If you want to get the link in your email every time I post a new article, you can subscribe to that. It's also free, and the link is below each article on the site.
Wolf, thank you so much for being on This Week in Money.
Thank you, Tim.
My guest has been Wolf Richter, publisher of wolfstreet.com. He was speaking to us from San Francisco. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Rick Ackerman, Martin Straith, and Wolf Richter. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.